Hey, welcome back. Corelogic just downgraded their latest housing market forecast over the next 12 months. This was just announced actually today at the time of filming this video. I didn't even realize that. I want to share what their forecast is, and I'm also going to share what their forecast was 1 year ago to see if they were accurate or not. I'm also going to share what's happening right now regarding home prices at a national level, but also for 10 major US metros. On top of that, stay tuned towards the end of this video. I'm going to talk about the metros in which they believe home prices will decrease the most over the next 12 months. I have a lot to share in today's video. Please like and subscribe, and let's begin today's video. So let's talk about what happened over the previous 12 months. So it says home prices nationwide increased year over year by 4.3% in July this year compared to July of 2023. Also, home prices decreased by 0.01% this July compared to June. So month to month, we're down by 0.01%, yet prices increased by 4.3% over the past 12 months. Something that caught my attention though regarding this decrease in prices down by 0.01%, this is actually slightly cooler than the long run average. On average, home prices tend to increase from June through July each and every year. So more on that here in a little bit. Before I share their latest housing market forecast over the next 12 months, here's a forecast posted 1 year ago back in September of 2023. Back then, they're forecasting for home prices to increase by 3.5% from July 2023 through July of 2024. And again, going back to the report posted today, again, we saw an increase of 4.3%. So not too far off their forecast of a gain of 3.5%. Let's have a look at their latest forecast, because over the next 12 months through July of 2025, they're calling for home prices to increase by 2.2%. This is quite a bit different compared to the previous 12 months. Again, from July last year through July this year, we saw a gain of 4.3%. Whereas this forecast over the next 12 months is only an increase of 2.2%. So basically they're calling for half the gains over the next 12 months compared to the previous year. This is what their chief economist had to say regarding this. It says home price growth moderates as sales remain slow. Monthly home price growth is starting to slip, and annual forecasts are showing smaller anticipated gains. In other words, this deceleration, home prices still increasing, but increasing at a slower clip. Much of this sluggishness can be attributed to the high mortgage rate environment that are continuing to challenge the housing market, and of course, home buyers as well. They have high home prices and of course, still elevated rates as well. As buyers remain cautious, sales remain low. So for example, based on my own analysis of the National Association of Realtors data, we're basically on track to have slightly fewer home sales of existing houses this year compared to last year. This is very much noteworthy because back in 2023, for the year as a whole, we had a 28-year low in closed home sales. So basically so far this year, we're on track to have fewer home sales last year. And last year we were basically at a 3-decade low. Also, pending home sales measured by the National Association of Realtors, they have what's called their pending home sale index, an index which measures the amount of people getting their offers accepted or pending home sales. That decreased to a new all-time record low for that report that was just posted about a couple weeks ago. So big picture, yes, it's true that we have a lack of home sales, historically speaking, basically on track to have a 3-decade low. On top of that, a future indication of closed home sales, that's pending home sales, decreased to a new all-time record low. So it actually could get a little bit worse here next couple of months. Corelogic also said this as well. However, the highly anticipated rate cuts from the Fed this fall, which actually is scheduled for September 18th, about 1 week from making this video. So those rate cuts from the Fed may help improve consumer purchase sentiment for the housing market. I emphasize sentiment because we're not talking about rates. Do not expect that rates will decrease once the Fed starts cutting rates, because the rates we're seeing today, when I mean rates, I'm talking about mortgage rates. The rates we're seeing today have already taken into account future rate cuts by the Fed. So I think it's very clever of them to use sentiment and, of course, not rates. So maybe people will be more confident about buying houses potentially if their sentiment increases once they see the Fed starts cutting rates in about 1 week from now. And by the way, I'll share some new insights regarding some expectations or forecasts for rate cuts for the remainder of the year. Some changes that have occurred over the past 1 month. In any case, it says housing demand continued to buckle under the pressure of high rates and unaffordable home prices, leading to a considerable slowing of home price gains during the summer months. July's prices were essentially flat from the month before, again, a decrease of 0.01%. And that was notably cooler than the average gain of 0.4% that's recorded from June through July prior to the pandemic, and especially during the pandemic years. So historically speaking, home prices tend to increase by 0.4% from June through July, yet this year it was relatively flat, down by 0.01%. And they're basically saying here this is from the pressure of elevated rates and, of course, unaffordable home prices as well. Please leave me a comment below regarding that. Do you guys think the housing market is unaffordable due to rates and or home prices? Please leave me a comment below. Anyways, it says the question for home prices going forward is whether the upcoming rate cut by the Fed and the expected continuation of falling mortgage rates will be sufficient to motivate potential buyers who may start to fear of a cooling labor market and continued uncertainty of a soft landing for a recession. On top of that, we have the anticipation about the presidential election as well, which is causing some people to kind of put their plans on hold to buy a house. And while lower mortgage rates are a boost to housing affordability and are likely to help buyer demand, the usual fall housing market slowdown is upon us and is likely to contain or minimize any significant surge in activity. So because we have seasonality of our housing market, where a housing market tends to cool off, especially during the holidays and the winter months, and on top of that, we have elevated rates and, of course, elevated prices as well. That's just likely going to contain any increase in home prices and sales for the remainder of the year. Now, having said that, I want to share this with you guys. This is according to the Mortgage News Daily on, what day is it? Tuesday. The average daily rate for a 30-year fix, according to them, is at 6.22%. That's a 3 basis point rate decrease compared to Monday. Also, for an FHA and VA loans, that's around 5.7%. So looking at the 1-year chart, looking at the 30-year fix, 1 year ago, we were at 7.22%. So rates are about 1 percentage point lower, or about 100 basis points lower compared to 1 year ago. Also, we're much lower than the 8% rates we saw back in mid-October last year. So zooming out, going back to approximately April last year at 6.22%, that's the lowest daily rates we've had going all the way back until Thursday, April 6, 2023, when the average daily rate back then was at 6.18%. So average rates right now are more or less at a 1.5 year low. We'll have to see if that improves home sales in the coming months. Now let's talk about the expectations for the Fed rate cuts or Fed rate cuts. And their next meeting is actually scheduled in 1 week from now, which is scheduled for September 18th. So the the federal funds rate, is at 5.50% right now. So the street is forecasting by a 69% probability the Fed is going to cut rates by 25 basis points down to 5.25%. This is much different compared to 1 month ago, because 1 month ago, the street was basically split between the Fed cutting rates by 25 basis points at a 49% probability and cutting rates by 50 basis points, a 51% probability. So right now, the Fed, or the Fed Watch tool here, which is the CME Fed Watch tool, is calling for the Fed to cut rates by only 25 basis points in about 1 week's time. Now, it's going to be a little different though, November 7th. This is all going to change based on incoming data, by the way. So there's a 53.2% chance that the Fed's going to cut rates down to 4.75%. So therefore, if the Fed cuts rates down to 5.25% in September, They're basically calling for a 50 basis point rate decrease by a 53% chance. Then to end the year, December 18th, they're calling for the Fed to cut rates again by 50 basis points down to 4.25%. In my personal opinion, leave me a comment below your thoughts regarding this. I think that a 25 basis point rate decrease followed by 2 consecutive 50 basis point rate cuts is actually more aggressive than I think they're actually going to do, unless the labor market slows down considerably, which will cause the Fed to cut rates more than anticipated. But what do you guys think about that? I just think that 50 basis point rate decreases, 2 consecutive meetings, is a little bit more aggressive than I think the Fed is actually going to do. But again, it's all going to depend on incoming inflation data, but especially regarding the labor market as well. Let's also talk about some things that really could impact mortgage rates this week, because I'm making this video on Tuesday, but on Wednesday, we have the CPI, or the Consumer Price Index, that will be posted at 5:30 a.m. Pacific Standard Time. I'm posting this video that you're watching at 6:30 a.m. So stay tuned for that, because that's going to be a really big market mover potentially. Also on Thursday, we have the weekly jobless claims, but also more importantly, the PPI, or the Producer Price Index. So the P stands for producer, and the C for the CPI stands for consumers. What prices of everyday consumers are paying, that's a CPI. The PPI is based on the increases in prices that producers are paying. So based on these two reports, we could see some very big volatility in rates this week. All right, let's get back to Corelogic's forecast. Let's talk about the gains in home prices for each of the 50 states. This is from July last year compared to July this year. So again, on a national level, home prices rose by 4.3% year over year. And on top of that, no states posted a decrease in prices compared to 12 months ago. Texas is actually very close. So this means less than 1%. This means that home prices increase in the range of 0.1% to 0.9% in Texas. Also, we have gains in the range of 1 to 3% in Florida, Louisiana, Utah, Colorado, Oregon, etc. In contrast, we saw big gains in Rhode Island, up by 10.6%, New Jersey up by 9.7%, Connecticut's up by 8.3%, South Dakota up by 8.1%, and Illinois is up by 7.5%. Also in California, where I live and work as a real estate agent here with my team, we're seeing gains in the range of 3 to 5%. Here's something I found to be interesting. Here is the map posted 1 year ago. This is a change in prices from July 2022 compared to July of 2023. And I remember making these videos 1 year ago saying that if you basically kind of split the US in half, the Western states are posting the biggest decreases in prices, whereas much of the Eastern region, especially the Northeast, are experiencing gains in home prices. In fact, Arizona, California, Colorado, Idaho, Montana, Nevada, Oregon, Texas, Utah, Washington, and Wyoming all saw home prices decrease compared to the previous year. Much different compared to the map we're seeing this year. We're seeing strong gains in much of the West, but especially in the Midwest and the Northeast. This can also be seen by 10 major US metros as well. Look at the map posted 1 year ago, back in September last year. We saw huge gains in Miami, up by 9%, but much of the West was down. San Diego was up by 1.3%, but Los Angeles down by 0.8%, Vegas down by 5%, Phoenix down by 4%, Denver down by 1%. But Chicago and Washington, but especially Miami, was up greatly. Here is the map right now, though. Big gains in San Diego, up by 6.2%. Denver barely squeaked out a gain, up by 1.4%. And Miami led the nation once again, up by 9%. Quite a bit. It's on par with last year. Also a gain of 9% as well. Also, Las Vegas has fully recovered, up by 7%. LA up by 4%. Phoenix also up by 3.5%. Chicago, Washington, D.C., and also Boston are seeing gains over 5% as well. Very interesting how the housing market, even though it does kind of move very slowly, how the changes from 1 year ago is so much different compared to what we're seeing today. Now, speaking of that, here are the top 5 markets in which Corelogic believes that home prices will decrease the most over the next 12 months. This is kind of some new cities I've been seeing here. So 3 of these markets are actually located in Florida. So number 1, Gainesville, Florida. Number 2, Palm Bay, Melbourne, Florida. Then we have Atlanta, Georgia, Lakeland, Winter Haven, Florida, and then rounding out the top 5, Ogden, Clearfield, Utah. These, by the way, all have a quote-unquote very high probability of home prices decreasing over the next 12 months going through July next year. With that said, please comment below with your biggest takeaways from today's video. Also, if you guys want a real estate agent referral, please check out my website, which is realestateteamfinder.com, or email me directly at jason@meetjasonwalter.com. We'd love to connect you with a great real estate agent in your neck of the woods. And with that said, I appreciate you guys so much for watching today's video. Please like and subscribe, and we'll see you in the next video. Have an amazing day.